Hello everybody, this is Shane Chu again. Okay, welcome everybody back to our Bursa webinar. In this session, we are going to talk about exchange traded bonds and Sukuk. Okay, so this webinar title is Build a Diversified Portfolio with Exchange Traded Bonds and Sukuk. Okay, so now if you can hear me, see our screen and see our speaker webcam and also our slide, please type yes. Okay, you can see and tell us where you are tuning in from. All right, cool. Yeah, we have YJ from Malacca. Thanks. Also, let us know, is this your first time to hear about exchange traded bonds or Sukuk, or you have been investing in exchange traded bonds and Sukuk for the past maybe X number of years. Oh, we have Marcus from Kota Kemuning. All right, cool. Well, we even have friends from Balikpapan, Indonesia. All right, thank you so much from tuning in. Okay, friends in Penang, Sandakan, Malacca. Okay, thank you. And wherever you are, please stay safe in this pandemic. Okay, now in KL, Selangor, CMC was just extended, so everybody please stay safe again, no matter where you tune in from. All right, so today our topic today is on exchange traded bonds and Sukuk. It may look new to most of you here today, but don't worry, our speaker will actually break down to you what exactly are bonds and what exactly are all these exchange traded bonds and Sukuk that's available for you to invest in the Bursa Malaysia market. Now, disclaimer as usual, whatever we share on this webinar is only for educational purpose. In no way that I give any recommendation to buy or sell any investment products or like bonds or Sukuk. So if you decide to buy anything, you do it at your own risk. Okay. Now allow me to introduce our speaker today. Now he's now on the line with us. Right now he is Ian Tai. If you have joined our previous two sessions, I think Ian Tai also facilitated two Bursa webinars prior to this. So he is the content producer of kclao.com, which is regarded as #1 financial blogger on Malaysia. And he has written 100 plus articles on kclao.com. He's also a regular webinar host and presenter, and occasionally I also appear on his webinars with kclao as a guest speaker. So he is the co-founder of dividendbot.com. So they manufacture competent dividend investor who can build dividend paying stock portfolios in Malaysia, Singapore, and Hong Kong independently. He himself is a dividend investor, so he invests primarily for dividend income, averaging about 4 to 8% in dividend yield per year. So that is Ian Tai. So Ian, are you ready to rock the house today?
Yep. Hello, Shane. Hi,
Right.
hi everyone.
All right, cool. Let me make you a
Yeah,
presenter first.
yes, of course. And while you do that, first and foremost, thank you so much for uh, having me on the show again. It's such a privilege and honor to be here on the Bursa platform to actually share a little bit about myself, what I do, and more importantly, today's topic, which is exchange traded bonds and Sukuk. So it's ETBS. All right. So this is what we are going to talk about today. And let's get right into the meat of the webinar today. Okay. So there are, I think, 1, 2, 3, 4, 5, 6 parts to this presentation. All right. And I'm going to make it very easy. And they are going to be moved very quickly because some of them, they are actually quite basic. And of course, at the latter part, we are going to do a little bit of calculations. So if you can, you may want to have your smartphone just right beside you so that when we are doing the calculations, then you can actually participate with us. So I believe that you are seeing my screen right now, where we are going to move into part 1, which is what is a bond. Okay. And this is actually the basic stuff, but it's very important for us to lay the right foundation so that we can understand what exactly is ETBS. So in this ETBS, we are going to start off with the word bond, which is B. All right. So what is a bond? So let me just give you an example where we are going to define what exactly is a bond. So let's say, for example, okay, so let's say we have a company. Let's just call it ABC Berhad. Okay, so we have a bond, and we have a company, ABC Berhad, and ABC Berhad, right? They want to undertake a project. Okay, so they have a project. They want to actually undertake the project, and they need money to do. They need money to do that. So therefore, they want to raise funds. Okay, So there are two ways that they can actually raise funds. Number one, they can actually issue out more shares to the company, more shares to the investment community. Okay, and if they do that, then that is called fundraising via equity. All right, they can do rights issue, private placements, and stuff like that. That one is actually shares. All right, that's the first option. But there's another option where the company can actually raise funds through issuing bonds. Okay, so let me just explain. So let's say ABC Berhad wants to raise funds to undertake a project, and the project costs 100 million ringgit. And let's say, for example, the company is just short by $50 million. All right, so what can the company do? So the company, let's say, instead of looking at shares, issuing shares, they can actually issue bonds to raise the shortfall of 50 million. All right, so these bonds, a bond contract will actually have these following details. Like, for example, we have principal sum, which is $50 million, the tenure, and the interest rate. Okay, so what happened is that an investor of the bond may actually buy the bond, all right, and the purpose of buying the bond is to earn the interest. Okay, so as you can see, a bond is practically a debt contract, all right, whereby the investors, people who buy the bond, are actually lending money to the company. So the company is the borrower, the investor who buys the bond is the lender. Okay, the lender will earn interest income from the borrower, which is the ABC Berhad, the company, where it is actually paying out interest costs, okay, for its $50 million. All right. So in essence, the company is the debtor, and it actually borrows money from the public. And with that money being borrowed from the investment community or the bondholders, they can use the money to then finance the project. So basically, that is actually a bond. All right. So this is the definition of bond. Now, as you can see over here, that is in essence a bond. All right. But of course, in Malaysia itself, and I believe this one can be applied throughout the world. All right, there are basically 5 different types of bonds, and we are going to go through them right away right now. All right, because there are many variations when it comes to the type of bonds. All right, so we are going to look into each and every single one of them very quickly. So let's take a look at the first one. All right, so these are the 5 types of bonds. So we have the fixed rate bonds. The second one is floating rate bonds. The third one is zero coupon bonds. The fourth one is convertible bonds, and the fifth one is perpetual bonds. Okay, so let's get into the first one. So the first one is actually called the fixed rate bond. All right, so fixed rate bond is something like this. Okay, so now I would like you to imagine yourself as the investor. You guys are the bond holders, and let's say I'm the presenter lah. Okay, so I'm gonna be ABC Berhad. All right, so I will be borrowing money from you, and you are lending money to me. All right, so the principal sum is 100 ringgit. So assuming that you are lending me 100 ringgit, all right, you are lending me 100 ringgit, and that 100 ringgit is actually the principal sum. And let's say in the contract, all right, I'm going to pay you back this 100 ringgit in 3 years time. Okay, you give me the money, I'm going to give you back in 3 years time. So the maturity is 3 years, and in this 3 years time, all right, there is a coupon rate. So the coupon rate is like your interest rate, all right, whereby I'm going to pay you 5% or $5, all right, for your lending. Okay, you lend me 100 ringgit, I'm going to give you $5 in interest income. I'm going to pay $5 in interest cost to you on a yearly basis for the next 3 years. So what happens is that you, as a bondholder, all right, what happens is that you will give me money, $100, and then I'll pay you $5 for the first year. The second year, I'll pay you $5. And then on the third year, I will also pay you the $5. And on top of that, I will return you the principal sum, which is $100. All right. So therefore, at the end of the day, you will be getting not just all right, but you also get back $15 in interest costs. So that is the first one, which is fixed rate bond. So why is it called fixed rate? Simply because the coupon rate is fixed. All right. As you can see, the interest income that you're going to receive is quite fixed at 5%. It can be 5%, it can be 4%, 3%, 7%. But the whole purpose the whole idea of why is it called a fixed rate bond is simply because the coupon rate is fixed. All right, that's type number one. Let's move on to type number two. Now, type number two is known as the floating rate bond. So what is it all about? So basically, it's the same like everything else is the same like type number one, the fixed rate bond. The only thing that is different is the coupon rate. So as you can see, we have the coupon rate where it is defined as follows. We can say it's the KL interbank offered rate or the CLIBOR. All right. So we have the CLIBOR rate plus a certain fixed percentage of let's say for example 1%. So which means to say let's say the CLIBOR is 4%, and let's say in the screen you see the X% is plus 1%. Let's assume that. So if the CLIBOR is 4%, then it'll be 4 plus 1. So your coupon rate is 5%. Let's say that happens to be year one. All right, year one, CLIBOR rate is 4% plus 1, so it's 5%. Year two, the CLIBOR rate is 3%, so therefore it's 3 plus 1, so it's 4%. And in year three, let's say the CLIBOR rate has climbed up to 5%, so it's 5 plus 1, which is 6%. So as you can see, why is it called floating rate? Simply because the interest rate or the coupon rate that I'll be paying you, all right, it fluctuates, it floats, all right, and it goes according to the rate of CLIBOR at that particular of time. So in that sense, you as the lender, what you will get is based on your returns will be very much based on the CLIBOR rate. All right. So if the CLIBOR rate is high, then you will get more returns. If the CLIBOR rate is actually at a lower rate, then you will get lesser returns. But everything else from type 1 and type 2 is more or less the same. The only thing different is the coupon rate. Now let's move on to the third type, which is the zero coupon rate bonds. Okay, so this is actually a little bit different from the first two types. So the first two types, right, what happened is that you lend me $100 and I'll give you back $100, and throughout the period of time you will receive interest income. Now there are two differences between the zero coupon bonds and the first two that I have just shared just now. So for the zero coupon bonds, let's assume that the maturity is also the same, it's 0%. Okay, so what happened is that this. Okay, usually, typically for a zero coupon bond, throughout the tenure, you will get nothing. You will get no interest income. So how does bond investors get money from it? All right. So let's say, for example, the principal sum of this bond is $100. So at the end of the day, I will have to pay you back $100. Okay. So how you make money is like this. All right. You will lend me money which is much lower than the principal sum. So let's say you could be lending me at, let's say, $85. Okay, as shown on the screen, $85. So you give me $85, and I will promise to actually pay you back the full principal sum of $100 after 3 years later. Okay, so that means you give me 85, I'll give you back $100 in the next 3 years. So that is how you make your profit from a zero coupon bond. So it's actually selling a debt. You are actually lending me a debt at a much lower rate, at a much lower principal sum than the original principal sum. Okay, so that is called the zero coupon rate bonds. All right, so that's the third type of bonds. And now we are going to move on to the fourth type. So the fourth type here is actually known as the convertible bonds. Okay, so now we are getting a little bit more technical here. So just now, if you remember, all right, we have let's use this as an example. Let's say, for example, we have the first type, which is the fixed rate bond, where you lend me $100, and I, as ABC Berhad, will collect the $100, and from this $100, I will pay you interest income every year, $5. Okay, and everything is the same like fixed rate bond, but the only difference is this. Okay, so in year three, all right, you as the lender, all right, you can actually choose. You can either choose to collect back, all right. I can actually pay you in full, $100, all right. You can take the money and that's it, all right. You can choose to do that, or alternatively, let's say you as a lender, instead of me paying you back the full principal sum of $100, you can actually take your debt contract and convert it into shares. All right. So from a bondholder of ABC Berhad, you can convert your bond into shares and thus become a shareholder of ABC Berhad. All right. So when you, of course, when you convert already, right, that means to say instead of you getting back in the principal amount in cash instead. So that is called convertible bonds. All right. Now the fifth one is perpetual bonds. Okay, so the perpetual bonds is something like this. All right. So why is it called perpetual? Perpetual is simply because, right, there's no definitive maturity date. So as you can see, the whole idea is very simple. The whole idea is similar to the first one, to the first bond, which is fixed rate bond, except that there's no maturity. All right. So which means you lend me $100 and me issue you let's say perpetual bond. So now you're a perpetual bond holder, and as a perpetual bond holder, there's no maturity date, right? So which means for as long as you live, for as long as the perpetual bonds exist, I'm gonna pay you $5, $5, $5, $5, $5 for almost eternity lah. Okay, and until the time, let's say I changed, until the time I decided to say, hey, you know what, I'm gonna buy back the perpetual bonds and end this thing. All right. But typically speaking, perpetual bonds simply means there's no definitive maturity date. All right. So these are the 5 types of bonds. All right. And now let's move on to the next one, which is part number 3, there where we are going to talk a little bit about why do companies issue bonds. Okay. So just now I've actually mentioned, all right, there are many ways that a company can actually raise funds. All right. So on one hand, the company decide to raise funds through how I say issue bonds, and we have explored different types of bonds just now. But at the same time, as a company, I can also go to the bank to actually borrow money from the bank, right? So what is the difference between issuing bonds to people like you as a bondholder versus going to the bank to actually borrow money? All right, is there a difference between the two? Well, there are quite a number of differences between the two, and we're going to explore this right now on the screen. All right, so there's a difference between the two. So the first one is this, okay? Compare, let's say, for example, today I can actually choose to go with a fixed bond. I can actually issue you a fixed bond or a floating bond to raise funds. All right. The beauty about doing this as compared to bank borrowings is this. With a fixed or floating bonds, I don't need to pay the principal, all right, throughout the period, the borrowing period. So let's say I want to borrow for let's say 3 years, okay? So in these 3 years, right, I don't need to actually pay principal back to my how do I say, to the debtor. All right. Yeah, you are the debtor. No, you are the creditor. I'm the debtor. All right. Let's not get confused. So I'm the borrower, you're the lender. So I don't need to pay you the principal. That's the beauty about using bonds as a vehicle to raise funds. Whereas if I use bank borrowings, throughout the 3 years period, most likely I will need to start to repay the principal. Okay, so that is the first one. All right, I don't need to pay the principal. I just need to pay the interest. All right. Number 2, if let's say I choose, instead of fixed or floating bonds, I use zero coupon bonds. So what happened is this, it's even better. I get the money from you. I don't even need to pay the principal, and I don't even need to pay the interest until the maturity of the bond. So this is actually very good cash flow management. It frees me up in terms of cash flow as compared to bank borrowings, where most likely the banks, right, will actually require the borrower to actually start paying both the principal and as well as the interest until the end of the loan agreement or the loan facility. All right. The third one is convertible bonds. Now, convertible bonds is actually issued as compared to bank borrowings. It's simply because if I issue convertible bonds, right, sometimes I don't even need to pay back the principal. All right, maybe you guys will be more than happy to receive the shares. So I say, good, I get to borrow money from you, but I don't need to pay you back. All right, I don't need to pay you back the actual full sum of the capital, but rather I will issue shares and invite you to become a shareholder. So that is another option. And finally, of course, perpetual bonds is even better because it is actually a vehicle where I don't need to pay. I just keep on paying the interest, and I don't need to like pay you back the principal. All right, because there's no definitive period of when this thing will expire. So these are the two differences. These are the differences between why a company may want to choose to use bonds, issue bonds to bondholders as a way to raise money, as compared to going to the bank conventionally to raise money or to borrow money, right? And next, we can actually compare bonds and shares, all right? So why some companies may choose to use bonds instead of shares, all right? So here are the differences between the two, and in all together, right, there are 5 main differences. So let's just explore them one by one. So here we go. So if you can see, when I issue bonds to you, all right, I still can retain the company's ownership. That means to say the ownership of the company that I have, right, it will not be diluted. All right. So that's the beauty of me issuing bonds to you as a bondholder rather than me issuing shares. So if I issue shares, right, my ownership, all right, the proportion of ownership that I have in the company will be diluted. So that's the first one. The second one is this. Of course, as a bond, right, I'll be paying bondholders like yourself um, more or less. If let's say it's a fixed rate bond or a floating rate bond, more or less I will have to pay you an interest cost. All right, so that means say more or less certain that I will have to fork out money and pay you. All right, that's for bonds. But some companies may want to use shares instead. All right, simply because, especially if let's say, for example, this one it really depends. Okay, on one hand, if let's say you are the type of company, right, that doesn't pay dividends, then obviously this is actually very good cash flow management lah from the company side. But sometimes this may not work simply because some shareholders, right, some investors, right, if let's say they don't get fixed income, like bonds, they get fixed income or fixed or floating income. What about shareholders? Maybe the shareholders want dividends, all right? So if let's say you give them shares already, right? You give them shares and your company actually grow over time and they still continue to hold on to the shares. And as the company grow, the asset grow, the sales grow, the profit grow, the dividend payouts that they will expect will also have to grow. So in the long term, all right, it may be more expensive for you to actually issue out shares to investors simply because they are expecting more dividends from you as the company actually expanded and grow in the future. All right. Whereas for bonds, if the company grow, all right, let's say they 2x, 5x, or 10x their sales and profits, their amount of interest, right, will not 2x, 5x, or 10x together. All right. They will still continue to get their fixed 3%, 4%, 5%, whatever is stipulated in the bond contract. All right. So that means to say their returns are practically fixed, not like investors who actually have shares. All right. They don't participate in the profits of the company. All right. So which actually talks about the third one, which I have overlapped with the third one, whereby if you have a bond, except for a perpetual bond, all right, most of the bonds have a maturity date. And after the maturity date, that's it. All right, the bondholder will get back their principal, and that's the end of things. But for if you actually issue out shares, right, they can actually own the shares, especially value investors. They can, like Warren Buffett, they can own the shares of the company like for eternity. And if they hold on to the shares for eternity, then you might, as the company owner, you might have to actually pay them dividends for eternity lah, for as long as they hold on to the shares. Okay. And now let's look at the fourth one. So what happened if, let's say, the company 2x, 5x, or 10x their sales and profits? So for bondholders, right, doesn't matter how the company perform, as long as the company exists, has cash to pay out, right, their returns are practically more or less certain, more or less quite predictable. But for shares, right, if I issue out shares and my company grow, then of course they will stand to gain a lot more, not just in dividend payments, but also some capital appreciation from their shares, simply because the business of ABC Berhad has actually grown over time. But the good thing about this is holding on to bonds than shares is like the fifth one. All right. So if, let's say, ABC Berhad just so happen to go bust, right, or go bankrupt, of course, as bondholders, they will actually, let's say my company ABC Berhad goes into liquidation, then of course, the ones who get the money first will be the bondholders. The last one to get the money will be the shareholders. All right, so these are the key differences between bonds and shares. Okay, so let's move on to the next one. And just now, for the first three parts here, we have actually talked about Sukuk. No, we have talked about bonds. Sorry, we have already spoken about bonds, and now I'm going to actually dive into Sukuk. Hopefully that whatever I've just explained just now, it's easy for you to understand and you don't find it too fast. All right, so now we are going to move into Sukuk. Now Sukuk is a different thing. Now here's the difference. Just now, bonds is about debt, and when it comes to debt, people will expect interest, and when it comes, and that's the word, all right, interest. Okay, in the Islamic world, right, they don't like to use the word interest, all right, simply because it's against the religion, all right. So preferably, right, they will rather use Sukuk, all right. But Sukuk is altogether a different thing, because like bonds is about debt where the bondholders get interest. Sukuk, on the other hand, it's a certificate of evidence of ownership of a certain thing. All right, it can be a company, it can be a project, or it can be an asset. All right. So now I'm going to explain how does a Sukuk work. So Sukuk, let's say for example, right now it's still the same thing. I'm ABC Berhad. All right, I have a project. All right, and I want to raise funds. And instead of raising bonds, I will issue out Sukuk. All right. So let's say you are interested to be a Sukuk investor. So you will buy the Sukuk. All right. So essentially what happened is that you will now own my project. You are now the owner of my project or the asset. All right. Or whatever that is stated in the Sukuk. All right. So now you have ownership. All right. But in that Sukuk contract, what happens is that you as the owner, all right, you're now the owner, but you will lease it back to me. You will rent the asset or the project back to me, ABC Berhad, all right, to run this asset or to run or manage the asset or the project. So in return, I will have to pay you periodic profits. It's like your rental income, all right, because you are leasing the whole asset or project to me, so I have to pay you some rental income, or they call it periodic profits, all right, for using the assets. Okay. And in a Sukuk, there's also a maturity period whereby it's like a rental contract lah. After the lease contract or the Sukuk contract expire, I can actually buy back the asset from you. Okay. So in that sense, there's no debt, there's no interest involved in the Sukuk. Okay. So a Sukuk is like you buying my asset and lease it back to me, and I will pay you rental income or leasing income, which is your profits as a Sukuk owner. And after it has matured, I can buy back the asset that I have sold to you. All right, and that is how the Sukuk work. All right, so as you can see, there are differences between a bond and the Sukuk, whereby bonds, if I issue you a bond, you don't own the asset. But if I issue you a Sukuk, you are now a partial owner of that asset because there are many Sukuk holders. So you own a piece of the asset. All right, so that's the key difference between the two. Bonds, no ownership. Sukuk, you are the owner. When it comes to earnings, bonds, you earn interest or coupons. Sukuk, you will earn profit sharing for owning the asset. Okay. Now, how do you value the bond? It all depends on, if I issue you the bond, all right, the value of the bond is based on my credit rating, okay, because I'm the borrower. So it's like, it's based on my secrets. Let's put it that way. It's based on my CTOS, my secrets. But when it comes to a Sukuk, the value of the Sukuk will be derived from the value of the asset itself, not me. It's based on the value of the project, okay? And of course, because bonds and Sukuks are quite different in nature, bonds will be compliant to the locality laws. Like in Malaysia, it will be compliant to the Malaysian law. And when it comes to Sukuk, of course, you can only use Sukuk, right, to finance Sharia compliant activities. So no such a thing called you raise Sukuk to actually fund anything which is outside or prohibited by the Sharia law. Okay, everything must be improper and in accordance to the Sharia law. All right, so that's very important, and that's the differences between the two, bonds and Sukuk. And now part number 5. Okay, so just now I've talked about bonds, and then I talk about the Sukuk, and right now we are going to calculate. We are going to do some maths where I'm going to show you some simple calculation on how do you calculate the yield of a bond. So this is part number 5. Now there are two types of yield. So the first one is actually current yield. All right. So the second one is yield to maturity. All right. Current yield to maturity. So the first one, current yield, it measures the interest income with bond purchase price per annum. The second one, yield to maturity, it measures total returns if investors hold onto a bond until maturity. Now, you may not understand what's all these things. I think it's best for me to actually use some examples to actually share what these two actually means. So let's go on. So let me just give you an example. All right, forget about the definition. Let's just look at the practicals. Okay, so let me just give you an example. All right, so this is a fixed rate bond where you as the bondholder, you are going to lend me $100, all right, for 3 years. And in that 3 years, every single year, I'll pay you $5 in, or 5% in, 5% or $5 in coupon rate or interest to you for your money, all right. And at the end of the 3rd year, I will pay you back the $5 and as well as the $100 in principal sum, all right. So therefore, what exactly is your return? So for this one is actually pretty simple, okay? So as you can see from this example, right, your returns will be 5%, all right? Now I'm going to change the situation here to the next one, which is scenario 1, whereby what if, let's say, for example, the example is actually pretty straightforward. You lend me $100, your return will be 5% for 3 years, so you get 555, and after that you get $100. All right, so this is a very simple, very straightforward kind of example. Now we are going to look at scenario 1, where what if lah, okay, what if along the way, let's say this is the bond, what if I say to you, your purchase price at year 1, you can actually buy the same bond not at $100 but at $95. Okay, So which means you have $95 here, and then you lend me, and then I'll pay you $5. So you lend me $95, and then I'll pay you $5 in interest the first year, $5 in interest the second year, and finally $5 in interest in the third year. And on top of that, I will pay you back $100 and not $95. I believe if you see this screen right, most likely you will see that your returns will be much higher than 5%. So how much is it? So now we are going to calculate it together. So this is actually the table to calculate. All right. So what happened is this. Okay. So now we have a cash outflow whereby at year one, all right, you paid $95 for it. All right. All right. Apologize to you guys. All right. So the first year, right, there's no interest because you buy the bond at year one itself, and the bond will mature in 2 years. All right. So that means you lend me the money at year one, $95, and at year two, I will start paying you $5. Year three, I'll pay you $5, and year four, there's no year four, and at the end of year three, I will pay you year two is 5, so therefore your returns over here would be 5.26%. All right, you can take 5 divided by 95 times 100%, so therefore your returns will be 5.26%. And moving on to year three, it's also the same thing. Your cash inflow is 5 divided by 95, and therefore your returns will be 5.26%. Okay, now these returns over here, the 5.26 over here, all right, is actually what I meant by your current yield. So, all right, which measures your interest income, which is the $5, with the bond purchase, which is your lending of $95, all right, on a per annum basis. So the 5.26% refers to the current yield. All right, now we are going to talk about the yield to maturity. So the maturity is at the end of year three, whereby you have collected $100. All right, so you lend me 95, you get 5 plus 5, and then you get back your final $100. All right. So what happened over here is that over here you also gain another $5. All right. So from this $5, we take 100 divide by 95, which is 5, and then actually in actuality you are holding on to the bond for 2 years. So we divide by 2, and therefore your returns is 2.5%. Okay, so therefore if you take your yield to maturity, so how do you calculate your yield to maturity is you take the 5.26%, which we had just now calculated, you plus 2.5, so therefore your yield to maturity is 7.76%. Okay, so this is your actual returns from investing in the bond. So it's no longer 5% in coupon rate, but rather your yield to maturity now is 7.76%. Okay, so maybe some of you are a bit confused, but don't worry, I have another example. All right, let's look at another example over here, which is scenario number 2. All right, so scenario number 2, bond price $95 at year 2. So which means right now you are actually buying the bond at $95 at year 2. The coupon rate is the same, $5. Maturity is 3 years, but you are buying it at year 2. Okay, so what happened to your cash flow is something like this. So as you can see, year 1, at the starting point you didn't buy, so nothing. Year 1 you didn't buy, so nothing. So your cash outflow, which is your investment, starts at year 2, where you pay $95. And then year 3 you collected $5 in coupon rate, which is your interest income, $5. And at the end of the year, at the end of the bond, you get $100. So now what is your return from this investment? So basically, all right, first we're going to calculate your current yield. All right, the first thing to do is to calculate your current yield. The next thing we are going to do is to calculate your yield to maturity. So your current yield, all right, starting here, the cash inflow, the first one, the interest is $5. So you take the $5, you divide it by 95. So therefore your current yield is also going to be 5.26%. Now, then we are going to calculate your yield to maturity, where we are going to talk about at the maturity time, you have collected $100. Okay, but instead of you holding onto the bond for 2 years, like scenario 1, you're just holding onto the bond for 1 year because you only buy the bond at year 2, all right, at $95. So how do you calculate is that you take $100, you minus off your 95, and then you divide it by 1 year, all right? So over here, you have to add another 5%. So if you take your current yield of 5.26% plus 5%, so therefore, your yield to maturity from this investment is 10.26%, all right? So of course, it's going to be a lot higher as compared to you when you buy the bond at year 1 at $95, okay? So now we are going to move into scenario number 3. All right, by scenario number 3, hopefully you get the hang of the calculation, how it works already. So now scenario 3, right, is actually the same like scenario 1, but the only difference is the purchase price. Okay, so it's the same type of bond, but the only difference is that instead of you buying at year 1, instead of you buying it at 95, you bought it at 105. All right. So you buy it at 105, year 2 you collected 5, year 3 you collected 5, and at the end of the bond you get back your $100. So what exactly is your return? So over here is actually tabulated as followed. By your cash outflow, you paid 105 at year 1. So your yield to maturity right now is, so your current yield is like this. You will take 5 divided by 5. Your current yield is 4.76%. Okay, 4.76%. And at the end of the 3rd year, all right, you collected $100, but you put in 105. So which means you actually rugi, you actually lost $5, all right, for holding onto the bond for 2 years. So you have to minus out 2.5%, which is 100 minus 105 divided by 2 years, which is negative 2.5%. So at the end of the day, your yield to maturity is 4.76%, which is your current yield, minus off your final one, which is the maturity one, which is 2.5. So therefore, your actual returns, if you do this, all right, is 2.26%. All right. So this is typically what will happen if you tend to buy the bond at a price above its principal sum. Of course, your yield to maturity from the investment will be much lower simply because of that. Okay. And of course, finally, scenario 4, this is also another revision whereby we are going to talk about it's actually another form of revision, and I'm going to give you the facts, and by now you should be more familiar with how it functions. So let's get right into it. And over here this time at year 2, you're getting your instead of you buying the bond at 95, you're buying the bond at 105. So let's just take a look at the cash flow statement and the calculation. So the cash outflow is at 105 at year 2. The cash inflow, you only collected one interest, which is $5. All right. And then at the end of the bond, you'll get back your $100. So in essence, what happened is this. All right. At year 2, you lend me 105. At year 3, I give you $5 and $100. All right, which means in essence you shouldn't be losing money, right? But actually you kind of like incurred an opportunity cost. All right, actually this is a no-brainer. Like, you shouldn't be lending me money if you are going to do this. All right, and here I'm going to explain why. Yes, your current yield for year 3, right? You can take 5. All right, there's a typo over here. Let's change this. All right, so now after I have fixed the typo, here's what happened. Your current yield, right, is 5 divided by 105. So your current yield is 4.76%. But as you can see, at maturity, you get back $100, but you put in 105. So you rugi $5. And this is after you have you have lent me the money for 1 year. All right, so you have to minus out 5%. So in essence, your yield to maturity, right, is 4.76% minus off 5. So therefore, you are making a loss of 0.26% from this investment. So this is actually not a very good idea. All right, so that actually concludes part number 5. And right now we're going to go into the final point, which is part number 6, ETBS versus bonds and Sukuk. Okay, so just now part 1, 2, 3, and 5, I talk about bonds. Part 4, I talk about Sukuk. And right now we are going to talk about exchange traded bonds and Sukuks. And I'm going to compare the exchange traded bonds and Sukuk with an actual bonds, actual Sukuk. All right, so let's get right into it. So basically, all right, exchange traded bonds and Sukuk, all right, is actually a very, very interesting vehicle. Why do I say so? Simply because, let's say if you want to, right now you want to buy a bond or you want to buy a Sukuk, actually you need to be really, really rich before you can do that. All right, why do I say so? Simply because the minimum amount of investment that you're going to make to buy yourself an actual bond or an actual Sukuk, right? It could be at least $250,000. All right. Typically, it can go beyond $500,000. It can be the size of investment that you need to put in is, it could be $500,000, it could be 1 million, 2 million, and so on and so forth. So in essence, you need to be a high net worth individual to buy yourself an actual bond. All right, which most people may not want to do so, even if they're high net worth individuals. Okay. So what happens is this. So Bursa came out with this exchange traded bonds and Sukuk. All right. So basically, it's a vehicle where it allows people like you and me, all right, to participate in bonds and Sukuk investment without having the 250,000, the $500,000 or $1 million in investment, all right, to get into it. With an exchange traded bonds and Sukuk, you can actually buy and sell bonds just like how you buy and sell shares in the stock market, all right? And you can actually invest into this for as little as $1,000, more or less, okay? Depending on the price. So instead of you spending 6 figures, now we can actually buy ETBS, all right, as another way to invest in bonds and Sukuk at just a fraction of a lot lower than 250,000, 500,000, and so on and so forth. You can actually buy them at 2,500, 5,000 with an ETBS. So typically, an ETBS, right? If you have a stock brokerage account, you can actually start to buy and sell ETBS, right, using your stock brokerage account. All right. Simply because the minimum trading size is just 10 units, and typically the principal sum or the IPO sum is actually about 100. So therefore, the minimum amount of investment that you can actually participate in this ETBS, right, is just $1,000. Unlike bonds and Sukuk, whereby you have to buy it over the counter, whereby if you have the money, you need to have a lot of money lah, like 250,000 just to buy over the minimum lah, just to buy the bond. All right, so this can be a very, I wouldn't say it's an expensive venture, but I would say it's a not so affordable method of participating in the bond and sukuk market. Oh, and finally, we have the part 7, where I'm going to do a case study with you guys, a short case study with you guys on an ETBS. All right. So basically, in Bursa Malaysia right now, right, of course, we don't have a lot of choices when it comes to ETBS. Currently, we have 4, all right, and 4 of them, right, the issuer, there are only 2 issuers that I find. The first one is from Dana Infra National Berhad, and the second one is from Ilsan Sukuk Berhad, okay? And today I'm going to take the case study from the first one, which is the first ETBS that is ever listed on Bursa Malaysia. And the issuer is from Dana Infra National Berhad, and the listing date is on the 8th of February 2013, whereby at that time they want to raise about 300 million. So their bond, the maturity date is 10 years. So the maturity date is on the 8th of February 2023, and the coupon rate is 4% per annum. All right, so these are the list of the key details. I actually covered everything except for the purpose, okay? So the purpose for having this ETBS, right, is simply because they want the money. It's actually, Dana Infra is more like a government thing, whereby they want to raise the funds, right, to finance the capital expenditure and as well as the operating expenditure of the KL MRT project, okay? The profit rate is 4%, whereby the payment frequency is semi-annual, means to say every 6 months they will pay 2%. So it's like first half of the year 2%, second half of the year they will pay 2%. All right. The redemption, which means at the end of the maturity, which is on the 8th of February 2023, if the principal sum is 100, then all the bondholders will get back 100%, which is $100 at the maturity of the bond. Okay, minimum subscription 10 units. So 10 units, par value $100. So therefore, the amount of investment the minimum amount of investment will be about $1,000 per trade. Okay, so let's assume okay, let's assume that at the point of time, let's say at 2020, because if you see right now the maturity date is 8 February 2023, listed on 8 February 2013. So which means to say at most this bond or this ETBS, it will only have about 2 years plus before it will expire or it will mature. So let's say at year 2020, which is over here, you get to purchase this ETBS at the price of 100 ringgit and 60 cents. All right, you are here, and then you stand to gain from the interest 444, and after you get your 444 at 2021, 2022, and 2023, you will get back 100% of the par value, which is $100. So what exactly is your yield to maturity or your total returns from this investment? So over here is very simple. You paid 100.6, $100.60. That's your cash outflow, and your cash inflow will be your 4% interest. So you have 444, and with that, your current yield of this investment is 3.98% for the next 3 years. And finally, at the end of the day, you will get back your $100. So if you take $100, you minus off what you have put in, which is $100.60, divide by 3 years. So therefore, you're at your maturity, right? You're kind of like lose 0.2%. So your yield to maturity is your current yield of 3.98% minus off the 0.2%. So your final returns is about 3.78% from this investment. So that's how you calculate the deal, the bond deal, the ETBS deal, and from there you can actually adjust according according to the current price of that EPBS. And with that, I will end my presentation. So thank you so much for listening to this session, webinar session. And with that, of course, you may have questions, and I would like to welcome that right now. And right now, I'm going to pass the control back to Shane. So Shane, I'm done.
Thank you so much, Ian. Thank you so much for doing this exchange traded bonds and Sukuk sessions.
Yep.